Hi, I'd like to welcome everybody once again to a Fast Five with myself, Greg Thompson of Thompson Wealth Management Solutions. I'm here with Rob Smith, and we're pleased to be joined by Mikhial Pasic, Vice President at RBC Dominion Securities. He's head of our alternative investments. Now, alternative investments are not new, but they're definitely more widespread these days and new to a wider range of investors, I think is the best way to put it. And there's a lot of misconceptions of what they are with regards to risk, what's in them, and how they're invested.
All opinions and views expressed by the speakers are not representative of views and opinions of RBC Dominion Securities, Inc. All information and opinions provided in this video are in good faith, but without legal responsibility.
So today, we just want to have a quick overview on this. We know we call this a Fast Five, and we try and keep it to 5 minutes, but I think, as Mikhial said, it should be called a terrific 20 because we'll probably run a little over 5. Anyways, Mikhial, thank you for joining us. You're in our Vancouver office. The sun is shining in the back. He does have a full face, kind of in the shadows there. But just, want to just talk to you about, what are alternatives? Where did they kind of come from? And, if you can kind of talk on, why they're gaining popularity at this time.
Sure, happy to, Greg. Great to be on with you and Rob here for this recording today. I'll come in and out of the shadows, I guess, as we go here with this lighting situation, but I'll do my best to stay in one place. So yeah, in terms of alternative investments, like maybe just starting definitionally, what are they? I think the cleanest way to sort of segment the alternative investment universe, which is a very amorphous and broad category, would be you have public market alternative investments and you got private market alternative investments. And the public market alternatives, these are investment solutions they're ultimately managers who are attaching to the same sorts of securities that you and Rob would often buy in your accounts, like it's publicly traded stocks or publicly traded bonds, but they're attaching to those investments in generally a more complex way, where they might be using leverage inside the strategy, they might be shorting inside the strategy, you might be using derivatives inside the strategy. So really, it's attaching to the same securities, but changing the risk return profile in some fashion, often dampening the volatility in terms of what those strategies are doing. So the simplest example, instead of owning stocks, you're running a market neutral or a long short portfolio, where instead of just buying one company's stock, you buy one company in an industry, you buy their stock, you short sell another company in the industry's stock. And so effectively, that is a more market neutral return stream where you're effectively earning the relative performance between the two positions you have on, as opposed to just earning a market return. So that's one example of a public market alternative. The other side is private market alternatives, where basically you are attaching yourself to either a business through an equity investment or a business through making a loan to them in a format that's non-traded, and the only way you can access it is through that private, kind of bilaterally transacted deal. So in a lending context, you might have a business with a unique capital need. It's a complicated loan to do, and there's a borrower is going straight up to a lender. They're negotiating amongst each other. The loan's not traded. It's all held by one party, who's the investor in the private credit transaction. Conversely, private equity, that's an ownership stake in a business that is not publicly traded. And so, really what, the public world, what that's giving you is a different way to attach from a return stream perspective, but the assets are accessible. The private world, the assets are generally inaccessible, and this is a vast universe. I mean, if you look at companies, you can set the minimum revenue threshold at 100 million, you can set it at $200 million, but if you look in the United States, anywhere between 80 and 90% of the companies in the United States are private businesses who hit that revenue threshold. So there's a sizable universe of companies that you can attach to. There's tons of lending activity that occurs outside of the public market, and private markets give you a way to access it. So just maybe definitionally to start the discussion here today, hopefully I didn't take all 20 minutes on defining it, Greg. That's, I think, a good starting point to just begin, and I'll hand it back to you maybe to see where we're going to take it from here.
Well, that's really interesting. So, you have private equity, you have private credit, you have long, short, you have leverage. Infrastructure is another one that people are talking about right now. With all these different choices, how do they augment, how do they help the investor? How do you find them being part of a portfolio and making that portfolio better, which is what we're always looking for.
Sure. And I think like to cut to the chase on this one, like the punchline is basically alternative investments give you they position you to earn a higher return and a smoother pathway to that higher return. But it's not like it's a one ticket solution, generally speaking, where you're making one investment in a single strategy and you're achieving that. From our perspective at RBC, it's a collection of different investments you're making along the different continuum of alternatives that when you add them to your portfolio, it's achieving that outcome for you. And so to unpack that example a bit, if you just think about your broad portfolio, you've got safer investments, short-term bonds, GICs, and you've got riskier investments. This is talking about the public traditional realm. You've got equities, right? They're for growth, they're for safety. You blend them together, it works well together. When you layer private investments and just alternative investments broadly into that, when you think about the return enhancing sleeve of what you're doing, what's private equity doing? Well, if you get rid of the marketing veneer of private equity is generally buying an equity stake in a smaller company, right? The company usually has more leverage than the stocks you would buy in your portfolio, and they have operational control over the business, which you don't have when you buy a stock. So, and you are tying up your capital to make the investment. It's an illiquid stake. You can't just trade the business the next day, the same way you can in the public market. And so all of those things are risk premiums in general that require an investor to pay for them, right? So if you just earned the same return on a private equity investment relative to a public equity investment, you probably should just stick with the public equity investment, right? The reason you would make the private investment is for assuming those additional risk premium or the additional risks you're taking on there, there's the prospect of earning a higher return. And historically, private equity has beat public equity by, there's different calculation methodologies, but to be very simplistic about it, call it 1.5% to 3% per year is what the outperformance has been. Now, not all of that outperformance means it's better. You're assuming risk in exchange for that outperformance, but on an apples to apples basis, that's generally how you're enhancing your return. So that's very clear. You're assuming some extra risks. You're driving enhanced return from those investments. On the safer side of the portfolio, if you own 9 bonds and you buy a 10th bond, that's not changing the composition of what you own really at all, right? You have the same risk factors. If interest rates go up, your bonds aren't going to help you. But if you add a solution like even a market neutral fund, right? So that's owns one stock, shorts another stock, the net exposure is 0 stock exposure. If you look at what that strategy does, that strategy's return stream is basically a return stream on cash, plus hopefully the outperformance they can generate by the calls they're making. And so that return stream, if you decompose it, it's like a cash plus 2% return probably, maybe 3 if they do a good job. That's equivalent to buying a medium risk corporate bond. And so really what you're kind of adding to your portfolio with a solution like that is a diversifying volatility dampening strategy that's adding stability to your portfolio. But in that basket of things that are safer, lower volatility, it's a different return profile than just buying a 10th bond in the example I provided. And so those kind of frame the edges on the low risk side of it and the high risk side of it from alternative investment strategies. There's a lot of things in the middle. You referenced infrastructure. You can buy infrastructure assets in the public market. You can buy them in the private market. Private credit, you can lend money to non-investment grade companies in the public market. You can do it in the private market. So it just expands the choices of things that you have along that overall continuum. And when you piece things together thoughtfully, that's where we think you can get that smoother pathway to the higher return. There's one more thing that I will say maybe optically makes alternative investments look even better than they are. And this is worth calling out. It can create a pleasant experience, right? Assets like private equity, where the returns are quite smooth. Optically, it looks beautiful on a piece of paper, right? Because you have a smooth pathway to this better return. The smooth pathway part is a little bit arbitrary because these are appraised valuations. They come in with a lag. They're either done monthly or they're done quarterly. That's not how your stock portfolio works or the public assets that you own, right? And so when we say smoother pathway to a higher return, we're trying to adjust for that dynamic, and we're not giving credit for that piece of it. The smoother part is coming from strategies like a market neutral fund, where it's giving you true volatility dampening.
I know, like for us, we are fans of the private credit and adding to our fixed income. and giving us some exposure to things that we cannot buy for our clients.
Absolutely.
So we've liked that private credit side of things. Rob, do you have a couple of questions here?
Yeah. So Mikhial, you talked about kind of providing, I guess, more options for investors. I'm just wondering if, the fund flows into these alternative investments, take market share away from traditional, stock and bond portfolios, or is it, the growth merely a fact of the average investor just becoming a little bit more wealthier and adding that further diversification?
Yeah, I think it's probably a nuanced answer, but it's a good topic of conversation for sure, Rob. I mean, if you look at I guess a few different angles of it, like I'd say on the increased adoption of these products, it's a function of a few different things. Like if you just look at the pension world overall, there's a big shift from defined benefit pensions to defined contribution pensions, right? And more people having to take their investing for their retirement, into their own hands. And I think that natural biggest buyers of a lot of these private market funds are pensions, and it's a shrinking share of where wealth sits today, and it's going to keep shrinking even more and more over time. And so I think a part of it is the manufacturers of these products and the fund companies appreciate they want to shift their business to be more in the private wealth channel, selling to individual investors. And so accordingly, you've seen fund structures change a lot, where the traditional institutional stick with private equity, or even private credit, which you referenced, Greg. Oftentimes, the way these strategies have historically worked is they ask investors to commit an amount of money. So say an investor commits, $100,000 that they're willing to invest in a fund, but instead of taking the $100,000 the first day, oftentimes the private market firm in the old regime would take none of it. They would just take your commitment and they would call down the capital and take it from you as they made investments. And then they would, when they sold those investments and realized a profit, return the money to you. And so it's a closed-end fund where you're tying your capital up for 7 to, in some cases, 12 or 15 years on the long end. So that's not a very investor-friendly vehicle, right? It's fine for a pension that has a perpetual life, or an endowment that has a perpetual life or a very, very long-term life, but not so much for an individual. And so I think you've seen product structure innovation in the space where there's been a growing shift towards vehicles that are open-ended products where they take all the money up front from an investor and there's no end date to it, and they offer some liquidity, often 3% or 5% of the size of the fund per quarter, where if the fund is $10 billion, they'll allow $300 or $500 million in aggregate to be redeemed in a given quarter. And so that structural adjustment makes accessing these products a viable option now for many investors where it would not have been, right? Now, there's still a lot of risk considerations every investor's got to go through and determine, can they afford to, A, potentially wait a quarter to get their money back, and B, cope with the uncertainty of whether they will actually get all of their money back in any given quarter based on what the rest of the fund flows are like. But that's a significantly, shorter bridge to cross than the prior one to go into a decade-long commitment. So I think that is probably the biggest thing from an adoption perspective, where the fund structures themselves have changed. And so then to your other piece of your question, what is it taking away from, right? Where are allocations shrinking? I mean, I think for a lot of the 2010s, the natural answer to that question was fixed income, because you had interest rates that were extremely low. And, if you can't achieve your target rate of return in the fixed income market, naturally, you're going to look for other places to go. And so that's, I think that was the de facto answer in the 2010s. I think it's morphing a little bit more now, where it's more nuanced, where, again, if you look at private equity as a category, quite naturally, you're going to take some of your allocation to public equity and move it into private equity, right? Private credit, that's custom loans that don't trade very much, that have a higher risk profile. If you sell government bonds to buy that, or sell GICs or let them mature and take the proceeds and buy private credit, you've added risk to your fixed income portfolio, because you're lending money to a credit that's generally a lower credit quality, probably a single B, in some cases even a triple C, possibly credit equivalent firm who you're lending money to, but you're doing so and earning more return. So I think you see in each category there's different motivations for what may move the money, but across the board, I mean, by definition, it's got to come from somewhere, right? And so definitionally, you've seen traditional, allocations to traditional assets shrink, and you've seen allocations to alternatives grow. Like, to put numbers on it, In the institutional world, you often have 25, 30% allocations to alternative investments broadly. In a private client setting in the US, for the large firms, the number's around maybe 6% total allocation to alternative investments. In Canada, it's about half that figure in terms of what you see in the private wealth space. There's certainly firms out there that have made this the focus, and there's larger allocations at certain places, but just for cuff it broad strokes, there's a much smaller allocation to these products in the individual channel, but it's growing, and I think it's coming at the expense of allocations to some other areas.
So last question for me then, and without getting too specific on fund names, what are some of the alternative investments that you find most interesting at present, and you think people should learn about? Maybe it's something that viewers would think, oh, I haven't thought about that as a investment, that kind of perspective. Anything come to mind?
Sure. I guess two things stand out. Greg alluded to private credit. I know that's topical for you guys and what we've spent a lot of our time in recent years chatting about. And private credit is just a generally interesting space right now. Maybe it was max interesting 2 years ago, but if you just zoom out and look at the world in 2018, it's harder to get enthusiastic about private credit when the base rate was close to zero and the compensation for credit risk in every single fixed income market was quite small, right? If you fast forward to kind of post the move up in interest rates that occurred through 2022, the base rate is now near the highest level in 20 years, especially on US dollar assets. And so your starting point from a return perspective is a healthy base rate. Now that's true if you buy a government bond or you buy an investment grade corporate bond, a high yield bond, a leveraged loan that's public, or private credit. But in general, that is a tailwind for fixed income that didn't exist previously. That carries over to private credit. There's also a growing number of financings that are occurring in the private credit space. Now the compensation for credit risk in private credit has moderated again. It's, you take your base rate, maybe you're getting 5 percentage points on top of that in terms of what the return is. So that's close to a double-digit return that exists there, and that's very interesting on a category that's got a contractual return. The last 3 years have been probably anomalously good for that category. Like if you look at a 20-year history, private equity, if you own the business versus lend the business money, you've made 5% more over a 20-year history. In the 2010 to 2021 period following the financial crisis, if you owned the business versus lent to it, you made 10% more per year. And so that was a great period to be an equity owner. Post 2021, so 2022 through 2024, where we have the numbers, private credit did around 5 percentage points better than private equity. That's anomalous, right? You shouldn't make 5 percentage points more as a lender long-term than owning the equity of a business. And so I think that, it's probably going to revert back to a more normal looking equity versus credit return, but it's still a pretty worthwhile number to earn a high single-digit, return in private credit. So that's a category that I think remains, an interesting one and a good way to enhance return in fixed income. The one other category I would just mention as an example of a strategy that I think is interesting is activist investing is challenging to do in the equity market. As much as you have strong opinions when you guys invest in a business, I'm not sure you sit on a public company board yet, Greg, and have influenced strategy and had any CEOs taken a task based on your viewpoint. It's really hard to do in a public portfolio. You have to have the know-how to do it. And most importantly, you have to have the staying power where if you get involved and, every investor in the market is trying to find an undervalued security, right? That's the baseline. But then, okay, what's the plan to unlock that value? Very few investors have an ability to effectuate that. And then you have to determine, even if you think you have a plan, do you have a path to go ahead and actually execute that strategy? In a hedge fund format where they can restrict your ability to redeem a fund to every quarter, that's a strategy you can actually go and look to put in place. And so I think that's, even if you just take, I'm just going to invest in traditional equities, how can I do it with alternatives? You're not going to run an active strategy yourself, but using the alternative investment kind of wrapper, that's an interesting way to bolster your traditional stock holdings, still in the public market, but through a manager that's doing something very different than you can do yourself. And that's where it's incumbent on, the team at head office to identify who's capable at that, who's good at that, and try to, profile that for you and make it available. But that would be, to me, another example of a category that I think is broadly an interesting one, and alternative investments provides a unique way to sort of attach yourself to that.
Sounds really interesting. And the great thing about my job is I tend to learn at least one new thing every day. So that is my new thing for today. It has been interesting to watch a number of activist investors over the years, Elliott Management and others in that realm. And, maybe that's one of the things that, we want to come back and follow up with you. We think there's so many things out there that people need to hear about, and they don't have to do it, but they should have the ability to say yes or no to it from an informed choice. So that's really what we're trying to do with this YouTube channel and these fast fives, although they're never 5 minutes. But
as long as it's not
so
the
much.
first one to go 20 here, Greg, then I don't feel so bad.
That's,
And maybe if it was me 5
true.
years ago on fixed income, I don't know that I feel better. But anyways,
There's nobody with a hook beside you pulling you away. But you know what? We will wrap it up now. But you know what? Let's come back to this in a couple of months and maybe talk about that activist investment strategy and just let the people hear more about it, so that again, they can make choices from an informed decision point of view. Okay. So we'll try and do it at a different time in the day so people see your bright
see my whole face if we do it later in the day, I guess, Greg.
But
So, you'll notice I don't have any hair though if we do it that way. So maybe we should stick with this time.
What's more important is the content. Anyways, Mikhial, we always thank you for your time. You have been so helpful to me over the years in fixed income and now on the alternative space. We're lucky to have you. So thank you so much.
Appreciate it. Thank you guys for having me. Take care.
Okay. Have a great day.